Here's something nobody talks about enough. You have $10,000 right now. You could pay off debt, stuff it in a savings account, or, and here's the thing, you can invest it in a way that actually builds real wealth over time. I'm going to show you three approaches to deploying that money, and the third one is something most people never even hear about unless they have a private wealth advisor on speed dial. So sit back, grab a cup of coffee, and let's get into it. All right, first things first. Most people here invest $10,000 and they immediately think stock market, individual company picks, timing the entry, and that's where most people get into trouble. The actual best move with 10,000 isn't exciting, but it's incredibly powerful. You put it into a low-cost index fund. Specifically, I'm talking about something like Vanguard's VOO or VTI, funds that essentially track the entire stock market for you without charging you an arm and a leg in fees. Here's why this works. The S&P 500 has returned roughly 10% annually over the past 50 years. That compounds magnificently over time. Put 10,000 in today, leave it alone, and in 10 years you're looking at around $67,000. 22 years, you're at $250,000. That's with almost zero effort on your part. The key is keeping your expense ratios below 0.2%. Anything above 1% will quietly eat your gains over decades. This is the foundation most people skip because it sounds too simple to actually work. Now, if you want to get a bit smarter about this, here's where things shift. Once you have your index fund locked in as the core, you can start thinking about where you're holding it, specifically tax-advantaged accounts. And I'm not talking about a regular brokerage account. I'm talking about maxing out a Roth IRA first. For 2024, you can contribute up to $7,000 per year. And if you're under 50, that's the limit. Here's why that matters. You invest with money you've already paid taxes on. That account then grows completely tax-free. Zero taxes when you withdraw in retirement. Compare that to a regular brokerage account where the IRS takes 15 to 20% of your gains every single year. The math on this is just different. Vanguard ran the numbers on a hypothetical investor who maxed a Roth IRA from age 22 to 65. That investor ended up with roughly $230,000 more than someone who put the same money in a taxable account earning identical returns, same contributions, same returns. $230,000 difference. That extra money came purely from not giving it to the government. If you drop $10,000 in a Roth IRA invested in that index fund, you're already ahead of 90% of people holding that same money in the wrong account type. If you're finding this helpful, go ahead and hit subscribe. I drop videos like this every week, and the next one is going to blow the doors off this one. All right, now for the one I've been saving. This is the move that most people never hear about unless they're working with a private wealth advisor, and it's completely changed how I think about deploying larger sums of money. Once you've got those first two steps handled, the index fund, the tax-advantaged account, you can actually layer in something most wealthy investors use to get even better returns. It's called direct indexing. Here's the deal. Traditionally, if you wanted to invest in the stock market, you'd buy a mutual fund or an ETF, which bundles everything together. Direct indexing flips that script. You own the individual stocks in an index directly. So instead of buying one ETF that tracks the S&P 500, you own all 500 stocks in your own brokerage account. And that opens up something incredible. Tax loss harvesting at scale. Every time one of those 500 stocks dips, you can sell it, realize the loss, and offset gains from other parts of your portfolio. You're basically turning market volatility into a tax advantage. A Fidelity study found that active tax loss harvesting added between 1% and 2% annually to after-tax returns for investors using the strategy. That compounds. Over 20 years on a $100,000 portfolio, an extra 1.5% per year is roughly $40,000 in your pocket instead of the IRS's. Now, here's why this is finally relevant to someone with $10,000. Direct indexing used to require a $1 million minimum investment and was basically reserved for hedge funds and ultra-high net worth individuals. But platforms like Wealthfront and Interactive Advisors now offer direct indexing accounts starting at $5,000. $5,000. That's the entry point now. So if you're putting $10,000 to work, you can literally split it. Put 5 into that low-cost index fund, put 5 into a direct indexing account through one of those platforms, and start harvesting tax losses from day one. Let me show you what that looks like in real numbers. You put $10,000 to work right now. 5 in a Vanguard index fund tracking the S&P 500. 5 in a direct indexing account with tax loss harvesting enabled. Over the next 10 years, that market returns its historical 10% average. But now you've added an extra 1.5% annually through active tax loss harvesting. That $10,000 becomes roughly $73,000 instead of $67,000. Over 20 years, you're looking at $260,000 instead of $240,000. That's a $20,000 difference from one strategy most people don't even know exists. So here's the recap. Three real moves with $10,000. First, drop it in a low-cost index fund like VOO or VTI and let compound growth do its thing. That's your foundation. Second, hold it inside a Roth IRA so the IRS never touches a single dollar of those gains. And third, once you've got those two locked in, layer in direct indexing through a platform like Wealthfront to actively harvest tax losses and turn market dips into permanent tax advantages. That three-step approach is how people who actually build serious wealth invest their money. It's not flashy. It's not gambling on meme stocks. It's boring, proven, and it works. If you got value from this, share it with someone who has $10,000 sitting in a savings account earning nothing. And if you haven't already, subscribe. Next week, I'm breaking down exactly why most people lose money in the stock market despite it being one of the simplest wealth building tools available. I'll see you then.